Hello, everyone. Welcome. I want to introduce you to Ravi Pandit from the CME Group. Ravi is the Executive Director of Interest Rate Products and OTC Products in Singapore. Hey, Ravi, how you going?
I'm doing very well, thanks. And it's great to be able to speak to your members through this medium.
Brilliant, fantastic. Well, thank you so much for your time and joining us. And I know you've got some very exciting products that you would like to talk to us about. And one of those products is the interest rate products. And I guess interest rates are very important, very topical at the moment. And I was just wondering, how interest rates are affected or how they add to the economy. What's the most important thing that drives interest rates in the economy as well?
Sure. So the first thing to note is that, these rates, interest rates, typically when people refer to level of interest rates, the base rate is the policy rate set by the central banks. And what the central banks look at is typically inflation measures, especially in the major economies.
Yes.
And the inflation measures are affected by factors such as economic indicators such as GDP, consumer behavior, employment rates, and so on. So all these drive inflation levels, which then lead to central banks making decisions about targeting particular rate policy. So this is the base rate, and obviously, when banks lend to consumers, etc., or to corporate customers, there is a markup from these rates. But this base rate, sets the sort of the levels for all the rates in the economy, which is why these are very widely watched. Currently, you must be seeing a lot of people are tracking the U.S. Fed. U.S. is the largest interest rates market in the world. And people are very closely watching what the Fed does because it does have an impact on the global economies. So other
Yes.
than the Fed policies, supply demand factors, just like any other market, supply demand factors play a role. How much the U.S. Treasury is issuing in terms of the debt to cover the deficits. Uh, Other factors could be when there's a crisis, there's risk on and risk off kind of situations.
Yes.
And then, the market kind of goes to the least risky situation when there's risk on, a risk
Yes.
off. So, that could affect the level of rates as well.
So, in terms of um, this subject called the yield curve, how is that important for traders to be aware of or to just be mindful of? How does that affect trading decisions or the economy? Can you tell us a little bit about that?
Sure. So, I mentioned the policy rate by the central banks, let's say the Fed policy rate, right? That is the base. But
Yes.
what is actually traded in the market is interest rate products across different tenors. So,
Right.
when the US government, for example, issues treasuries, they tend to issue them in different maturities, varying from 1 week all the way to 30 years and sometimes even beyond.
Right.
And there are benchmark maturities, within this spectrum. So the market is trading all these benchmark maturities. Essentially, the levels of the rates at these different tenors is based on the market's expectations of what is likely, over time. So the market forms a view of how the rates are likely to move over time. And
Yes.
you do see a lot of swings in not just the level of rates, but also in the relative positioning. So, like for example, the 2-year rate versus the 10-year rate in the case of treasuries is very commonly watched by the market. And this has been swing. The spread between the two has been swinging around quite a bit
Right.
as the market is adjusting their forward expectations of rates.
And where are we currently positioned with the yield curve at the moment?
So at the moment, the curve is inverted. The short rates are higher. This is because the Fed has been the market expects the Fed to be close to the end of its hiking cycle, and
Yes.
it's expecting it to start cutting rates in the near term. And you can track the expectations of the Fed policy on. We have a free to use web tool called the Fed Watch tool. which is
Right.
available on our website. And
Yes.
this tool shows for all the upcoming Fed meetings with known dates, what is the probability of the Fed decision, whether it's, what is the probability of a cut going forward. So since the
Right.
market is expecting the Fed to start cutting, in the next few months,
Yes.
the longer dated rates are a little bit lower than the shorter dated rates, which is why the curve is inverted.
Right. That makes sense. And so with the interest rates products, how is risk measured for those
So
type
that's a
of
great
products?
question. So there is a concept of DVO1, which stands for, or is also referred to as the basis point value of a 1 basis point change.
Right.
The short form for that is DVO1. And what that means is, interest rates are quoted in percentage terms, as you know.
Yes.
And it's typically they're quoted to the second decimal, right? So a
Yes.
rate of, let's say, 4.50%.
Yes.
If that rate moves to 4.51% or 0.01% change, what would be
Yes.
the change in the underlying price of the instrument? So that is
Yes.
referred to as the DVO1, or the basis point value of the instrument.
Right.
And typically the risk is measured in terms of the DVO1. Longer dated instruments have a greater price movement for the same 0.01% move in the interest rate. And they have a higher DVO1, and which is why they are considered riskier than the shorter dated instruments.
So in that situation, if the market moved by 0.01 of a
Mm-hmm.
percentage, that would be worth, in terms of contract value on some of the products, it would be
Mm-hmm.
worth, say, the yield futures, say that would be worth $10. Is that correct?
Yeah, so why don't I jump into yield futures, since you've sort
Yes.
of raised that contract.
Yes.
So there's a couple of things, we've done at CME to try and make interest rates, user friendly for retail traders.
Yes.
So first of all, we've come up with a bunch of, web tools. I spoke about the FedWatch tool already. In
Yes.
addition to that, we have other tools which help our users and traders analyze interest rate markets to form their own view of the markets. So obviously, traders have a view when they trade, and they need certain tools in order to form these views. So I'll just mention a couple of these tools. We have something called a Treasury Analytics tool, which shows the historical value of these yield futures, which I'm going to talk about shortly.
Yes.
There's another tool called the Treasury Watch tool, which shows the users what is the upcoming supply and demand in terms of Treasury futures. And in addition to these tools, we also have a lot of educational material on our website, on the cmegroup.com website, which explains the products and which also talks about the basics of interest rates tradings. In addition to these tools, we also have products, right, which are very client relevant. And yield futures, the one you mentioned, is, I would say, the prime product from a retail trader perspective. So as you know, most market participants, think of interest rates in yield terms. So the
Yes.
level of interest rate, or in the case of a bond, the yield of the bond.
Yes.
Uh, what we have done is we have created these futures, which are monthly contracts, which are traded directly in yield terms. So these are cash settled to the US Treasury markets at the end of the month. So they're monthly products.
Yes.
And essentially, during the month, clients are forming a view on what is the yield of that US Treasury likely to be at the end of the month. Or, it's a representation of the forward level of the yield. So
Yes.
you're trading directly in yield terms. You don't have to do any price to yield conversions, etc. And because it's quoted in yield terms, it's very similar to commodity products, which a lot of retail traders trade. So if you feel the value of the yield is going up, so interest rates going up, you buy the future. And if
Yes.
you feel the value of the yield is going down, you sell the future. Very similar to other commodity products. You mentioned the DVO1 of $10, and we've designed these products so that the DV01 of all the maturities is $10, just to make it very simple. And they are available in 2-year, 5-year, 10-year, and 30-year maturities. All of these have a DV01 of $10. So if the underlying yield at that maturity changes by 0.01%, the profit or loss is $10. The
That's
most
brilliant.
popular is the 10-year maturity, which is the benchmark tenor for most interest rates, other than the central bank policy rate. So that has attracted the most interest. And you can also trade the yield curve by trading spreads between these contracts. So you can trade the 2-year versus the 10-year. For example, if you wanted to trade the 2-10s yield curve spread, and because the DV01 for both is $10, you just need to do one contract of each in order to do a risk neutral yield curve trade.
That's one thing. I looked at the CME website, and there is a lot of great education and information on these products, and I was very impressed by the products, and I really like the way you've made these interest rate products, or these government bonds, or these treasury note products really palatable for the retail trader. I remember when I first started trading, I looked into trading government bonds, and the 30-year government bond, the ZB code, and the 10-year treasury note, which was the ZN. And it was just a little bit confusing for the retail perspective. So I think what you've done by making the product traded based on the interest rate or based on the yield is a great idea. And I really thank you for the CME for coming out with these products, because I think this is a wonderful addition to the suite of products that our traders or futures traders can trade, not only intraday but also over for a longer period as well.
Sure.
Holding for longer periods than days or even weeks. So, and like you said, with the spread type trading, that type of trading, there's lots of opportunities, and there's lots of videos on and great education in the CME website on how to do that as well. So brilliant work.
There's one white paper I'd like to point your traders to. You are the day trading academy, so I assume you have a lot of day trader members. So we have published a white paper which is available on the website. It's called Key Macroeconomic Events Create Profitable Yield Futures Trading Opportunities. That's the title of the paper. So
Brilliant.
what we've done there is analyze for 2023 what the intraday range was, from the high yield to the low yield for different days. And, there are certain days on which the market is more active, like when there's a FOMC meeting, or when there's a inflation release, or when there's a non-farm payroll release, which is the unemployment number.
Yes.
So on these days on which there are, key economic releases, the daily range is between 14 and 16 basis points. Right? So 0.14% to 0.16%. That's the daily range.
Right.
On a normal day, just a normal trading day when there's no economic release, it drops to around 11 or 12 basis points. Right. So there is still a lot of activity going on in the rate markets. And this is for the 10-year, by the way, the 10-year yield future. Yes. So there is still a lot of, range in the market between the high and the low for day traders to take use of. And, just as a guide, these products, the 10-year yield futures, are trading with a bid offer spread of 0.02% or 0.2 basis points. 0.002%, third decimal. So 0.2 basis points. So, it's a very, very liquid market, a very tight bid offer spread. And there's a good opportunity in terms of intraday ranges for clients to do intraday trading using these contracts.
Absolutely, I've noticed that. I've loaded up some of the charts and had a look at some of the movement. I was quite impressed with the volatility. So yeah, I think there's a lot of scope for a lot of day traders to use these products as a secondary market or a backup market if they're maybe an index trader or a commodity trader. I think it's a great idea to have a secondary or a third market to have a look at. And like you said, these these interest rate products are very influenced by news events. And at the moment, we're seeing a lot of financial news coming out, particularly this year, 2024 being a presidential election year in the US. There's going to be a lot of volatility. We've already seen the stock markets moving strongly, and the gold market's moving strong, and the some of those cryptocurrency markets are moving incredibly strong. So it's a really exciting year for the markets. So it's a great opportunity for traders to find out more about what the CME has on offer. Now,
Yeah.
if anyone wants to find out more about these yield futures, you mentioned there's the white paper. There's also the CME website that has a lot of information. Is there anything else, Ravi, where traders can find out more about the product?
So, I think the website has all the complete information pack which is necessary to start trading the product.
Yes,
Most of the retail platforms are offering these futures,
yes,
the major platforms. So they just need to check with their providers, whether they can access these. You might
yes,
be interested to know about the margin for these futures.
yes.
They tend to vary between 300 and 370 US dollars, depending on the maturity. So they are very retail friendly. That's for one contract, obviously.
And that's
Uh,
an overnight margin too, isn't it?
that's the initial margin, which the exchange calls it the initial margin.
Yes,
That's what the exchange charges the clearing member, who
yes,
the clients have an account with. What the clearing member charges the clients is out of our control, but
that's right.
that gives the numbers I gave you just give you a rough idea
Yes,
about the margin sizes. And we have the standard treasury futures which you referred to earlier, right? Which are
yes,
more institutional friendly products. They're
yes,
trading for the last 30 plus years and trading in massive volumes.
yes,
But they are a bit complex to understand and they need specialized knowledge. Just to give you a comparison, the margins for those contracts typically are about 10 times the margin for these yield futures.
yes. Yeah, that's what I think, I'm most excited about them is because of the lower margins, the intraday margins, the initial margins are very reasonable. People can hold, day positions or they can hold overnight positions. It's quite, for a retail trader, they're very accessible products, which I think is wonderful. Um, Also, one other thing I wanted to ask about was the, uh, I think I've asked about the margins. Oh, I think we've covered all those questions, I believe. The expiry of the contracts, they're monthly contracts.
Yeah, they're monthly, so they're
Yes,
calendar month contracts. The front month, which is the current month, is the most liquid. There is
yes,
an ability to, if client wanted to, hold an open position over the month end, there is a roll market, so you can roll from the front month to the next month, and there's no worry about physical deliveries because they're cash settled futures.
brilliant.
So every month end we look at CME has a cash platform called BrokerTech, which is the most active interdealer cash treasury platform. So we look at the on the run fixing from that platform, and then we use that to cash settle the future on the last business day of the month.
That's brilliant. And Ravi, do you know the exchange that these products are run out of?
Well, the underlying, yeah, it's a CBOT basically. So
The
CME
CBOT,
has,
yes,
a few underlying, uh, you know, legacy exchanges. So CME,
yes,
CBOT, NYMEX, and COMEX. So yield
yes,
futures come under CBOT, which is the
yes.
same as where the standard treasury futures also come under.
That's right. So for any traders out there that are trading, say, the index type products like the S&P 500 or the NASDAQ, they may need to look at an extra data feed on their
Yes. If they're
current.
trading agriculture products, then there's highly likely that, that's on CBOT.
Yes,
Uh, but yeah, if they're trading energy or equity, then they may need to look at additional data feeds.
brilliant. Well, I think that about covers it all. Ravi, is there anything else that we need to cover off on before we complete this discussion?
No, I think we've covered, most of the key points. So, I hope this was useful from yours and your, members' perspective. And, we look forward to participation by your members in our yield futures.
Absolutely. Yes. Thank you, Ravi. I believe the effect that the news has on interest rates is so important, and it gives day traders an opportunity to be really there on the spot to take advantage of the volatility from these yield products. And I think they're a product which is a lot easier for retail clients to understand and to be able to take advantage of these changes in these interest rates that occur on a daily basis. So thank you, Ravi, and thank you to the CME for providing such great products and a great service for us traders to be able to participate in. And we look forward to meeting you again and talking with you real soon.
My
Thanks, Ravi.
pleasure. Thank you. Thanks, Cameron.